We're going to start today by looking at the S&P 500. Let's look at the one-year chart. You can see that we're in an established uptrend. We're above all other moving averages, including the really important 20-day exponential moving average. So that's a sign of momentum whenever a stock or a index is above all of its moving averages. You can see that we were oversold in the 1 week ago, and now we're still a little bit oversold in the process of um, finishing up the holiday week. You can see in our meeting notes, we expected a good week because people are always excited about Christmas and New Year's, and that's called the Santa Rally. So we are actually having that Santa Rally now, and it should happen till the end of the year. Let's look at our seasonality. Seasonality-wise, January is usually good. February isn't good. There are a lot of reasons why February isn't good. There aren't earnings reports coming out in that month. Also, the weather in the Northeast of the United States, where most of the trading happens, it's really dismal. So people aren't in a good mood. We have earnings reports coming out in March. So that is something to look forward to. Now, let's look at some of the earnings that came out in the last week. We had Micron come out with their earnings this past Wednesday, and they were more than stellar. They were awesome, and they guided they guided really good also. So you have a combination of great earnings. They beat their earnings, and they guided higher, and so they went up 10% that day. Um, we also had a couple other stocks reporting this week. Not that much, not very sequent. Um, they didn't mean much. But in the coming week, we have almost we have one earnings report, a very small stock. So the next 2 weeks, we have no earnings coming out basically for any big stock. Um, then we um, then we start off with the some of the banks a little bit later on in January. In January. All right, let's go to our talking points. S&P is up 0.5% from last week. We have a lot of momentum in the stock market. 60% of the S&P stocks are above their 200-day moving average. So, and we have 61% above the 50-day moving average. That's a sign of momentum. So that means our charts are favoring higher prices. Um, it's a good time to review at the end of the year, some of our theories and ideas from the beginning of the year. So at the beginning of the year, we were thinking that maybe healthcare, telecom, financials, energy, utilities, biotech, which did bad last year, would actually do good this year. We had healthcare actually did pretty good towards the end of the year. It's actually the best performing sector in the past 2 months. Um, we had financials do pretty good this year also, and utilities. Biotech just it started going up in the past 2 months. So basically, what happened in the last year was everything that did good the year before did good this year. So, let's look at our. There it is right here. So we had last year we had IT up 54%. Now it's up 39%. So no, this year it's up 30%, and IT is up 24%. Um, so we basically had the underperforming sectors from 2024 also out underperform this year. But we did have one sector, healthcare, it's up 13%. When the year before, it was up 1%. So we're starting to see the healthcare sector outperform. All right, so let's go back and look at more of our talking points. Mm, okay, so I guess the next in the next session we'll have like a prediction for what's coming next year. So next year, um, we'll probably have a continuation of the AI theme. We'll probably have more healthcare outperforming and financials doing good because of our current environment. Energy is kind of interesting because uh, we're having lower oil prices due to maybe overproduction and some of the OPEC production quotas. And we have a slowing of the economy around the world. So it's going to be real hard for energy to do good in that kind of environment. So next version of this, we'll have like a outlook for the next year. What else are we going to say here? Okay, so the 10-year really hasn't changed a whole lot. We have, let's look at the 10, see, let's look at the 10-year. You can see that we still have an inverse correlation. As the yield for the 10-year goes down, you can see we're like in a downtrend here. The S&P 500 goes up. So that's like a normal correlation. And that's primarily because as the yield of a guaranteed instrument goes down, people reach for yield and they reach for higher returns in the stock market. Now, if we had a 10% yielding treasury, people would not want to pay as much for stocks and the stocks would go down or people would not pay as much for them. All right, so that's good. Let me see. Okay, let's look at our S&P 500 chart. Our hold on. Let's look at the trend lines for our S&P 500. You can see that we have a perfect um, trend line starting in April, and we're basically hit the bottom of that trend line like a week ago, and we were oversold. And right now we're actually in the middle of the Santa rally, so we probably will go back up to here towards the end of the year in the chart, and we'll probably be overbought towards the end of the year also. So, but it looks very positive because we're above all the moving averages, and we have momentum. And we have good earnings reports too. The interesting thing about the stock market is the increase in the earnings for the S&P 500 is almost a one-to-one correlation to how much the stock market went up this year. So there wasn't multiple expansion. It was basically the S&P went up 14% because the earnings of the S&P 500 went up 14%. And their earnings are supposed to go up next year too. So that's all positive for the stock market to continue to go up. All right, let's look at some of our major variables. The price of oil hasn't changed since last week. We have the inflation around 3%. That hasn't changed. The US dollar index, it's down this week. If you can see the index is basically flat for the past since May. That is kind of good for stocks because that's gives stocks consistent earnings and without a whole lot of variation due to currency um, issues. So because of this, we're not going to have as much of a support for the materials or the commodities. Commodities usually, as the U.S. dollar goes down, the price of commodities go up. So right now we don't have the dollar going down anymore. So let's look at the price of gold. The price of gold is up another 3%. We'll look at that chart a little later on, but it is on fire right now, most likely due to central banks buying and diversifying against the dollar. Okay, so let's look at the fear and greed index. Fear and greed index is at greed now. Our translation is caution, take some profits off the table or don't buy. So we've been in extreme fear for the past 2 months, and we just got out of that, and we're into greed mode now. And we actually expected that. We've been saying since the beginning of the year that people are greedy and excited around the holidays. So we're expecting this greed to persist probably into the middle of January. Okay, so there's a fear of missing out. We have end of quarter window dressing. That's what this dark red is right here. That is whenever money managers, mutual fund managers want to make their top 10 portfolio positions look good. They're going to buy the best performing stocks of the year and they're going to sell their worst so they don't have the a bad stock in their top 10. So all that happens in the last week or two of the year. Um, so expect the stocks that have done the best so far this year to continue to go up until the end of the year. We do have Christmas, and this past Thursday we've had triple witching. That is whenever the options expire, and there's a lot of volatility. So we lived through that. That is awesome, and we had a Fed meeting, so that didn't derail anything. Next on our calendar, we have New Year's, so we expect at least a rally into the new year because stocks rally around holidays. And then we have probably earnings season starting up again. So let's look at some of our talking points. Okay, average stock month market returns. Let's see how this did this year. Um, you can see in December we did have a good month so far. Um, I think for the most part this has been pretty good, accurate. The volatility definitely goes down towards the end of the year. We're at yearly lows in the volatility right now, according to this chart. So this is pretty accurate. So we're going to keep looking at this average stock market returns because it seems like it's working pretty good. Okay, so next thing we're going to look at the AAII sentiment survey. So the amateur investor is bullish right now. Um, so that's expected because we just said towards the end of the year, people were excited. Um, so we can translate this into people are going to be bullish until probably mid-January. Then, then you don't buy and take profits off the table. Right now, we're going to have some momentum towards the end of the year. Okay, the VIX you can see is at 14. That is really low. That means there's no fear in the market and the stocks will continue to go up. Okay, our fear greed index, we switched from fear last week to greed this week. So right now we had a good earnings report from Micron that came out this past Wednesday, and that alleviated a lot of the fears of the AI bubble bursting because they showed very good demand. We'll go over Micron a little bit later. And let me see. Okay, so right now we have greed, and usually that's not the time to buy. Usually that's the time to the professional sell. Let's look at the interesting thing about S&P 500 PE ratio, we're currently trading at a highs that we've seen at peaks in the past. However, um, I think you can classify this as you pay more for a car that starts in the morning. Um, we're paying 23 PE for the S&P 500. However, we're continuously growing at 14%, and the earnings estimates are going to be 14% higher for next year. So it seems like a one-to-one correlation, earnings growth in the S&P to um, how much the S&P goes up every year. So we have a little bit of a premium. We're growing at like maybe 14 or 15%, but we're trading, the PE is at 23. So we're at an advanced level in the um, PE ratio, but still, we're still growing our earnings. So it's not getting carried away. Let's look at some of the first to worst from last year. Um, the worst performing, the best performing sectors from 2024, 37%, 39, 30. We have an outperforming communication and IT service again this year. The worst performing sectors, real estate, it can't get out of its own way. It has not earned anything in 2 years, 3 years. So healthcare is they're up 13% and industrials up 19%. So we have a lot of the sectors that performed the best last year performing the best this year also. And that's probably because these sectors their earnings are much better than the other sectors. Um, I choose to have a good portion of my portfolio in communication services, IT, because they grow the most, and I'm a growth investor. And I have like maybe 5% of my money in XLF kind of stocks, and then I have another 5 to 10% into healthcare. So we'll see what happens next year. We'll have to make another prediction and follow that. Let's look at the S&P sector's valuations relative to history. One thing that popped out to me is real estate versus the 10-year percentile rank. We are not paying anything for real estate right now, and it's at the lowest percentile ranking since for the last 10 years. We had healthcare that was at the bottom of this year, but now we're actually starting to pay what we normally pay for it. So healthcare has gone up a bit. Um, all right, so IT isn't as expensive as it was maybe 6 months ago because of the earnings and the stocks have gone down just a little bit too in that sector. Okay, let's look at some of the stocks going up and down. Okay, you can see First Solar. Um, we had the government cancel some wind farms projects, um, and the natural beneficiary of that are other renewable sources such as solar. We had Norwegian Cruise. I think Synopsis. No, I'm not sure. Um, you can see Merck is in the top before we went over Merck a couple weeks ago. This is an example of a stock that has a PE ratio of around 9, where the rest of the stocks in the S&P 500 have a PE of 20. So so there's a chase for getting into different sectors in the healthcare, and this is one of the least expensive stocks in that sector. We have Newmont Corporation. We went over that last week, and you can see it's up like 10%, 5 or 10% since last week. This is like a one-to-one correlation to the price of gold. Gold has been like on fire recently, so it has gone up a lot. Let me see. Constellation Brands. They they make liquor. There was an announcement that Jim Beam isn't being made in America anymore. Um, maybe they're up on that news. Let's see, Micron. We just talked about Micron last week and this week. We'll go over the details of Micron later on in our talk. Micron had a great earnings report, and they've been going up 10% on the day of the earnings report and 5% every day since then. Let's see. Okay, I can't see any other um, things in common there. Top decliners. Seagate Technology. We have Dollar Tree. Okay, we have a lot of beverage companies in the top uh, underperformers. We have Molson Coors Beverage Company. We have, let's see, Lamb Weston. They make French fries, the largest French fry maker in the country. And I don't see any combination here. Okay, Seagate. We're going to go over Seagate a little bit later on today. They make hard drives, and um, Motley Fool says they're one of the better companies for next year. So we'll look at their numbers. Mm. Okay, I can't see anything else interesting in this top holdings. Let's look at the sectors going up and down the most. We noticed that in our charts, the yield for the 10-year is going down in general. So our translation, yields of the 10-year going down. That's good for small cap stocks. Any stocks that need to borrow money, cost of refinance um, is less if you have a lower yield. Um, anything yielding high yielding, it's great. So we expect utilities, healthcare, consumer staples, home builders, speculative companies. Okay, those are all companies that benefit from lower yields. Let's look and see if that's what happened. Sectors. We have gold miners. Okay, gold related stocks. That's the one-to-one correlation to the price of gold, which has been going up. As the yield to the 10-year goes down, we have telecom stocks, which are very high yielding, going up. That is just what we said. We have biotech companies. As the yield goes down on a 10-year, that makes it more affordable for companies like biotechs to borrow money. So that makes sense. And let's look at the stocks going down the most. Home construction. Hmm. If you have the 10-year going down, that would make it more affordable for home builders. So we expected home builders to go up, but it did not. They went down today. Um, okay, that was a good exercise. Okay, let's look at the Dan Niles picks from the beginning of the year. You can see that Cisco is up 32%. That was his best pick. ADTN is okay at 8%, but KBWB, the large cap bank ETF, is up 31%. That is pretty amazing. So the financials, the big banks did good. His choice of having cash is very, I don't know if that was a good decision, if he was going to hold that through the whole year, because you only get like 2 or 3% on your cash right now. And for that being 20% of your portfolio, I'm not sure if that was a good idea. IJJ was only up 7%. That's the mid-cap ETF. So it'd be interesting in the next week. We're going to have new picks from Dan Niles. We'll see what he says for next year. All right, so here's some charts I picked out that were interesting. You can see that gold is overbought and it continues to go higher. Right now, it's halfway between its trend line and it's definitely overbought. You can see that this continuous price appreciation is making all of the gold miners and gold related stocks go up with it. We went over Newmont mining last week and it's up 10% since we reviewed it. Let's look at silver. Silver is actually more on fire than gold. It's almost doubled since the beginning of this year. Um, we're going to keep our eyes on silver and gold. Hmm. And this is it works at silver is interesting because it's um, it's a little bit different than gold in that it has an industrial purpose. It's used in semiconductors and it's a very good conductor of electricity. So it's actually used in um, industrial use and manufacturing. So this is very interesting. We're going to watch both silver and gold, and it's also a hedge in bad times. Whenever the stock market goes down, and you have governments like the United States spending uh, uncontrolled spending, then you have silver and gold as a way to maintain a certain value of your investment over time. Okay, let's look at another one. XLU, look at this. It's been going up in an uptrend, but we're actually at the bottom end of its trend line and we're oversold. While almost every other sector is up, XLU is actually oversold and toward the bottom of their range. Looking ahead towards next year, we're still going to have a high demand for electricity and energy for the data centers, for the AI data centers. So this could be one of those stocks that we'll choose as a contrary pick for next year because it's out of favor right now. It's broken through most of its moving averages. So we're going to keep our eye on that. It has a high yield, and it actually gives you a dividend while you're investing in it. And it's kind of um, has a growth kicker to it if you're investing in this index. All right, so we'll look at that for next year. Um, look at this chart on Google. You can see that we're oversold right now. You can see there was a big drawdown in Google recently, and we're still above the 20-day exponential moving average, this yellow line, and all the other moving averages. And we're actually going into the Christmas, New Year's holiday time. So this is one of the stocks that are kind of out of favor right now, and it's oversold. But Google is actually it's turning out to be an AI winner, and it's actually their models are a lot better than the other companies right now. So and they got through their antitrust case. So right now things are lining up for Google pretty good. Let's look at some of our stock screens for this week. We can see Newmont Mining we picked out last week. It seems like it's undervalued. We have Pinterest. It's a very small company. It seems like it's undervalued. And look at this Micron. It seems like it's undervalued here. I'm looking at the PEG ratio. I sorted by PEG ratio this time. You can see. And what I've been trying to do is focus on market caps that are larger market caps, because in general they're a little bit more reliable companies. So the other day we went through Barclays. They have a 87 billion market cap, and we were reviewing it around 20, and now it's at 25. So so it's fun for me to look at the PEG ratio because it's um, simple number that gives you how much they're undervalued. A lot of these companies are undervalued for a reason. Um, Almost every stock that's selling for a peg ratio of less than one has some kind of fleas or problems with the stock. It just you have to dig into the stock to really find out if you can live with that and if it's going to hurt the company long term. So let's look at one of these stocks again, this Micron, which is zero point 0.3 peg ratio according to Fidelity. Um, it's actually a big company. It's 300 billion market cap. So a little bit more growing, and they're going to be $1 trillion valuation. Okay, let's look at this story from the Motley Fool. Could this AI leader be the market's best performer next year? Um, First of all, Micron stock, it went up 10% since their earnings report. They just reported a strong quarter for sales and earnings growth. The company benefits from increasing demand for their memory, and their stock is majorly volatile. Remember, if you invest in this stock, it'll go up and down 20% in a heartbeat. If you buy it today, it could go down 5% or 10% tomorrow. And you just have to live with that because this whole sector is super volatile. But its long-term growth is intact, according to, yeah, this um, full company. Micron just reported their strong earnings growth. They beat their earnings. And okay, so we looked at their earnings estimates. You can see that they're growing at 94%. And from this year to next year, only 12% from the year 26 to 27, but they're up to 114% from 28 to 29. So let's say they're growing at 100% if you averaged this together. The PE ratio right now is 10. Can you believe that at 10? So their PEG ratio is 0.1. That's 10 times undervalued. Their Here's this part of this article. It says Micron sales and earnings continue to rocket higher. Micron just reported the results, and the company proved that it can continue growing its top and bottom line at a healthy clip. Sales rose by 50%, 56% year over year. That beat their 12.8 billion estimates, and their earnings surged 167% higher, and that beat analyst estimates. So they had a really good earnings report. Okay, look at their PE. This is just amazing. When every other stock in the S&P 500 is trading at 20 PE or 30 PE, this stock is half of that. So if they just re-rated to what the stock market is paying for a stock, they would double. And you can see that Yahoo Finance thinks they're undervalued by half. Their profit margin and operating margin is right where we're looking for. That's double what we're looking for profit margin, and operating margin is 4 times what we're looking for. And their return on equity is double what we're looking for. They have about 2 billion in debt compared to a 333 billion market cap. That's pocket change, so it's not a big deal. I like to look at the analyst notes that come out right after the earnings report, and CFRA just said the buy opinion maintains buy opinion on Micron. We lift our target to 283 from 200 on a PE of 8.5. They think that they have 40% annual compounded annual growth rate. So okay, they think they can be about, let's see, we expect a record free cash flow. We see 20 billion annually to be used aggressively to pay down debt. Valuation is fluid. And one could argue it's going to shift to higher valuation margin offerings with more upside. Price hikes likely to prove unsustainable over time. But they've been raising their prices for their memory, and that's hurting the other companies. But so far, they've been able to get away with by raising prices. So they have a buy recommendation. If we look at um, Morningstar, they think it's 20% overvalued. They said their earnings have shot through the stratosphere with no signs of abating. Their October results were strong, and January quarter was even better. Midpoints management is sequentially guiding 37% revenue growth and their margin expansion and 76% EPS growth. All right, so CFRA, they have a buy recommendation. They say our buy recommends reflects valuation view and that the memory space will grow through 27. Their upsides supported by secular AI growth, creating robust demand and tight supply for high bandwidth memory. Micron executing on structural DRAM shifts, technology leaderships, and favorable market conditions. With entire calendar year 2026 supplies sold out, providing visibility and quite in pricing upside. High bandwidth memory represents structural shift where memory becomes strategic AI enabler, creating durable upcycle. So they've already sold out their inventory for 2026. So they gave estimates that were really good. And so they have a lot of vision of how much they're going to sell. CFRA thinks their fair value is 313. So they think it's undervalued by 26%. The one bad thing about Micron, if I look back, their earnings are like hit and miss. You can see that sometimes you don't have a whole lot of demand, then you have a lot of demand. Um, that's just part of this industry. The chip industry is just sometimes companies pre-order and you have a ton of sales and then you don't have any sales. Um, so you got to be willing, if you buy this company today, to sit through a very volatile time. It might go down 20% or 50%, and then it'll go up 50%. So you got to be ready for that when you buy this. So it might be good to dollar cost into a position if you're not comfortable with volatility. So establish like a smaller position now and then buy more when it goes down 20%. All right. Well, that's all I had to say for today. I hope you enjoyed the talk. Um, and I hope you have a great holiday season. And I'll see you next time.